Hello folks, Sean Shell, founding partner of Reliant Wealth Planning. We've been going through some interesting times in the market throughout the full year, and what we wanted to do is reach out to you and explain to you a little bit about what we see going on, and even more importantly, what we're doing within the portfolios and elsewhere to help you deal with that situation. As you probably know, the markets have been struggling a bit. So let's take a look at that. As of the end of April, which was the last full month as of the making of this video, the S&P 500, which represents some of the largest stocks in the US, was down about 13.9%, right at about 14. The NASDAQ, which is also US stocks, but much more tech focused and growth focused, it was down 21%. That was where the market was getting hit the hardest, is in technology and the more growthy names. International wasn't faring much better. Internationally, the average was down about 12%. And even in the safe harbor, what are seen as the safe things, bonds. Bonds were down as of the end of April about 9.5%. So we look at these numbers and they don't look very good, but I want to put this in some kind of historical perspective for us first. As we look at this chart right here, I think it's very useful. This goes all the way back to 1980, so this is 4 decades worth of data. What these black bars show is in any particular year, so for instance, this is 1980, from January 1 to December 31st, what was the rate of return for that year? What did the market do, the US market, in that year? So 1980 was up 26%. What's really important on this chart, however, is to take a look at this red down here. And what the red is illustrating is even during good years, and a lot of times we don't feel this, which is the interesting point, even in great years, there are times that the market drops from a peak to a bottom. Even in good years, there can be significant drops. And we can look at 1980 again, market's up 26%. Fantastic return. But at some point during that year, from a top to the bottom, the market was down 17% at some point during that. And we can just see that historically. There's nothing overly unique about that. So if we go over here, this is 1998. 1998, market closed up 27% for the year. Again, a phenomenal year. But at some point in the year, from a top to a bottom, it went down 19%. And it changes. Sometimes it only went down 3. Other times here it was down almost 50. It moves up and down. So what we can see from this chart, on average, that move is down 14. That is the average amount that the market drops from a top to a bottom during a year. I've drawn a little dotted green line here for you to see that. Down 14 is exactly where we were as of the end of April. So basically, on average, some years are better than that, some years are worse than that, and we were completely average as of April. Now, I'm not trying to diminish really what's going on in the world right now, and we do need to acknowledge the current challenges. By that, you know what I mean. There's a war going on in Europe between the Ukraine and Russia, of which we really don't know how that's going to end up. There's inflation going on across the world. That's not just a US problem. COVID-driven supply issues are still impacting supply chains. And these are not all mutually exclusive of each other. The war in Europe and the COVID supply chain issues are all impacting inflation. It's all kind of a vicious cycle. We don't really know how it's going to end up. So I don't mean to belittle anything that's going on in the year, but it is interesting to gain a little perspective. As of right now, we look completely average with the amount that the market has dropped. So having said that, I'm about to surprise you, I think. And I'm going to surprise you in what I'm not going to say. What I'm not going to say is, you know what, whatever your portfolio looked like in the beginning of the year, it's fine. Just stay in that, hunker down, and let's just wait for things to get better. That's not what I'm going to say. And I'm not going to say it because that's not what we've done. We have actually been very active in the portfolios, restructuring them at several points during the year to try to make sure we look proactive for what we think is coming and to set us up best for the future and in the environment that we're in. So having said that, real quick, just to give you a reminder, so what we do here at Reliant is we build various portfolio templates. Different clients are in different templates, but we've created these templates. That's just the start point, though. We then take the template and we adjust it to each client. And we have to adjust it because different clients have different individual risk tolerances. They have different situations as far as their planning needs. They have different personal preferences and they have different tax scenarios. So we have to take all that into account. So we start with a template and then we adjust it to you. Having said that, what that means is, so we're about to look at some of the things we've done in the portfolio, but realize that will apply in varying degrees to any particular person because the portfolios have been customized to the individual. So having said that, let's get the ball rolling and look at what's been happening. The core portfolios, what we call the core, which is one layer of the investments that we do, all core portfolios can be divided into two assets. There's stuff that's there to be defensive, and there's the growth. All portfolios can be divided that way. It's kind of the top line of how to look at a portfolio. So what's on the defensive side? Well, there's bonds. The good old standby of bonds are seen as defensive. Cash and money markets are all obviously very defensive. And then there are other a little more sophisticated protective strategies, and we're going to touch on those in a second. But all of these combined are considered defensive assets because, yes, when things are going well and the economy is really firing on all cylinders, they can make money. But more importantly, when things start to struggle, these are the things that are supposed to kind of save us and not go down as much as some of the other growth assets. Speaking of which, on the growth side, these are the things when the economy's doing well, yep, this is where your returns are going to come from. Long term, when you look at how you've done, most of that's probably going to come from the growth side of the portfolio. So what is on that side of the portfolio? Things like natural resources are considered growth assets. Real estate is a growth asset, and then the granddaddy of them all inside of portfolios is stocks. Whatever kind of stock you're talking about, that's considered a growth asset. So we have made adjustments on both sides of the portfolio, both defensive and growth. So let's look at what we've done there. On the defensive side of the portfolio, in the beginning of the year newsletter that we sent out to you all, we had a big discussion about the defensive side of the portfolio. So if you hadn't seen that, I recommend you check it out. Either go on our website or pull up that email that you got with it in there. But what's interesting about looking at it now is that was written in the beginning of the year, and we were saying, hey, this is what we see coming, and a lot of that stuff has now come to fruition. A lot of the things we talked about with inflation and interest rates and their impact on bonds and how crypto fits into that, all that kind of stuff, at that time, again, you can check us out and say, well, that's what you said then. How has that worked out? You might be surprised on how close we were on that. So what have we done in the portfolio? To understand why we've done what we've done, it's important to understand this basic relationship. So there is a really strong relationship between bond prices and interest rates. And this is how it works. If interest rates go up, bond prices go down. It's that simple. A lot of people talk about things that can impact stock prices, and sometimes they're right and sometimes they're wrong because stocks have a lot more variables going on in them. But bond prices, this relationship is pretty set. This isn't a guess. It's not a, oh yeah, a lot of times this happens. No, this is a pretty set mathematical relationship. Interest rates go up, bond prices go down. However, not all bonds are impacted the same ways. And there's two major factors that we can look at to figure out how is any particular bond going to be impacted. And the first factor is maturity length. Basically, the longer it takes a bond to mature, the more impact it'll have from interest rates or the more sensitive it is. So a 30-year Treasury bond is going to be a lot more sensitive to interest rates than a 2-year Treasury bond. It's just the way that works. And the second thing is the coupon, or how much interest is a bond paying off. And the relationship there is the smaller the coupon, the more sensitive it is. So for instance, if you're looking at several bonds that all mature in 5 years, so they have the same maturity, but a couple of the bonds are treasuries or munis versus another bond being a corporate, well, treasuries and munis tend to pay lower coupons on average, so they're probably going to be more interest rate sensitive than a corporate bond, which tends to pay a little higher interest, that all mature at the same time. So it's these two relationships combined that really tell us how much of an impact will interest rates have on any particular bond. Taking that into account, before even 2022 started, our defensive side of the portfolio looked like this. About 75% of it was in some kind of intermediate bond investment that looked a lot like the index. So there is a bond index, just like there's stock indexes. The bond index is made up of corporate bonds and treasury bonds. There's mortgage bonds in there. It's spread out. The maturities on them are intermediate, means it's kind of in the middle. It's not really long-term bonds, but they're not super short either. That's what 75% of that portfolio was in. But even before this year, we started to readjust the portfolios to deal with rising interest rates. So even before the year started, still 25% of the defensive side was in short-term bonds. If you remember back to what we just talked about, shorter term bonds are less sensitive to interest rates. So we already had 25% of the portfolio re-engineered in that direction. 2022 starts, we started doing more. So in early of 2022, we moved a full 40% of the entire defensive portfolio. 40% of it, all of that 40% came out of the intermediate bond investments. We moved 40% into protective strategies that are less sensitive to interest rates but can still protect. These are strategies we use, things like a merger arbitrage strategy, and we use market neutral strategies. And these are more complicated strategies. The important thing to know about them is that they are all what are often referred to as absolute return strategies. And what that means is whether the market's going up or going down, they are trying to, on an absolute basis, not relative, absolute basis, create a positive rate of return. And the way they're doing that makes them less sensitive to interest rates than, say, bonds, but they are not as exposed to things as, say, growth, just buy and hold stocks or real estate to downturns. Since we have done this, what is interesting is to look at the merger arbitrage that we bought in most people's portfolios is now the best performing asset that's been in the portfolio since we bought it. Whether you're looking at the defensive side or the growth side, it doesn't matter. It is the number one performer in the portfolio, seconded only by the market neutral. So these two things that we added early in 2022 have become the best performers in the portfolios. Then more recently, we took another 35% of that defensive side of the portfolio and moved it to ETFs they're buying bonds, but they're buying bonds a little differently than, say, most mutual funds or ETFs do. They are buying individual bonds and they're holding them to maturity. So they buy them and then they will not sell them until they mature. What they're trying to do is what's called an interest rate immunization strategy, and we're going to look at that in a second, but that's important to controlling interest rate risk as well. So this is what the defensive side of the portfolio looks like as of today. It's 25% short-term bonds. It's 35% of some type of interest rate immunization strategy, and then 40% in protective strategies that are less sensitive to interest rates, like merger arbitrage or market neutral. That's what it looks like. So let's dive a little bit more into this bond immunization strategy, because that's an interesting sounding thing, and I want you to understand what that means. So when we buy one of these exchange traded funds that's buying these individual bonds, well, we know what we're going to pay for it. So at any particular set time in the very beginning, we say, okay, we pay this for this investment. Great. When we buy it, we also happen to know something. It's going to have a maturity date on it. So not only is the ETF buying things with maturity dates, the ETF itself, or the exchange traded fund, has its own maturity date. And we know what we're going to get very closely when it matures. We have a really good idea of exactly what we're going to get. I can't say we know it to the exact penny, but we have a very good idea of what we're going to get at maturity. So we know what we're paying. We have a really good idea of what we're going to get once it matures. The one thing we don't know, though, is what the pathway is going to look like between those two dots. So between the time we buy it and the time it matures, what's the price going to do? And it can do lots of things. It might look like this. It might go up a lot in the beginning and then kind of moderate in the middle and then shoot up at the end. That might be what it looks like. It might look more like this. It might be kind of moderate throughout the middle and then shoot up in the end. Or it could actually do this, to be frank. We could buy it and it goes down for a while, only to really shoot up at the end. Any of those is possible. The important thing is, though, we know the start point and the end point. And that's why we say it immunizes you against interest rate risk. because no matter what interest rates do in the middle, we know kind of what our rate of return is going to look like for these things. So that's what that immunization part of the bond portfolio did for us. Let's shift now to the growth side and look at it. Pre-2022, part of everybody's growth portfolio was in U.S. stocks, and there were different kinds of stocks in there. About 60% of the U.S. stock hold was in what we would call total market exposure. So it had stocks of large companies, medium-sized companies, and small companies. They were spread out amongst all different kinds of sectors, so it was a very diversified mix. That was about 60%. And then another 40% was in more active management, where managers were deciding what areas of the market did they want to be in and how much did they want in those areas, and et cetera, et cetera. So that's what the U.S. stock looked like. International stocks, we then held a portion in international stocks, and most people also had a portion in real estate. So we started making adjustments in 2022 based off the environment. And one of the adjustments we made is we took all the money that was in that active management, 40% of it that was on the U.S. stock side, and we moved it to investments that were more value oriented and mostly that paid dividends. Again, if you go back to our beginning of the year newsletter, we talked about this as well, that the stock market at the end of 2021 looked the most expensive it ever had through most of history. It was the second most expensive market by some measures that we'd ever seen in the U.S. stock market. And when the market gets that expensive, it tends to fix itself. And by fix itself, we mean it becomes less expensive. And it does that in one of two ways. Either the earnings shoot up or the prices go down. And on average, that means the prices go down. So we moved the money into this more value-oriented, meant stocks that didn't look as expensive. So there's certain types of stocks that weren't as expensive as others. And a lot of those happen to pay dividends. And dividends kind of help cushion the blow when we're in a high interest rate, high inflationary environment. They tend to fare a little better. So we reoriented the portfolio more toward value and dividends to help manage the system shocks, if it were. We also did some things on the international side. We took a little less than half of the international stocks that we held, and we put those in a type of strategy that was hedging the currency risk. Now, what does that mean? International stock returns actually come from two very different sources, unlike the U.S. stocks. The first source is like U.S. stocks. International managers are looking for an international stock. They want to buy it for $10 and hope it goes to 15. They make money that way. But there's another way they make money, and that is in the currency exchange. What I mean by that is if they buy a European stock, they probably had to buy it in euros. And as that stock makes profits or pays off dividends, it's paying off in euros. But this is a U.S. investment, so all that has to be translated back to U.S. dollars. So the currency exchange rates matter in international investing. Right now, we are in a very strong dollar environment because of the war in Europe and some other things happening in Asia. The dollar is extremely strong right now. In that kind of environment, being able to hedge that exchange rate actually helps the returns a lot. So because we're in this strong dollar environment, we think we're going to stay there for a little while. We moved a decent chunk of the international investments to something that would help us hedge that exchange rate. That's called currency hedge. That's on the core side. Then we also have what we call TAPA, Tactical Allocation of Passive Assets. Several of you are in that strategy. Just as a quick reminder, TAPA is a proprietary active portfolio strategy used by us and no one else. We developed it. We're the only users of it. What TAPA is doing is using some mathematical measurements that academic research has shown us have a pretty good ability to help us predict near-term recessions or large sustained market drops. And there's two important words in that. On the recessions, it's near-term recessions. And on the market drops, sustained market drops. So that's really what we're looking for. Near-term recessions or sustained market drops. The measures aren't perfect. Nothing's perfect at looking at that. It's stacking the deck in our favor. All the things we look at, the academics have shown are a better than coin toss chance of helping us do that. So we look at more than one. Once we look at these measures and they tell us something, we use those measures to make trading decisions. Those trading decisions could lead us to decide that TAPA should be 100% stock. It can be 100% out of the stock market, or it can be something in between. And really, I think the best way to think of TAPA is as of a giant control panel. Okay, and on that control panel right here, first what we're looking at is what we call our primary trade signal. And this tells us, hey, you should move money out of stock. That's the primary signal, and it's based off of what's called a trend measure. And this trend measure is the research has shown, hey, when certain patterns or trends happen in the market, the chance for recession or near-term drops is really higher than it would be otherwise. So what we're doing is looking for this trend measure. If it tells us to trade, then we start looking at what we call these secondary strength signals. Because just because we're supposed to trade, we got to then ask, how much should we move? How much should we get out of the stock market? That's what the secondary strength signals tell us. One thing we look at is the inverted yield curve and how inverted it is. And then another thing is we're looking at a velocity measure, or how fast are certain things happening. Because again, research shows, hey, certain speeds are better indicators of recession than others. So this is what we're looking at. So where does the control panel show us today? Well, on the trend measure, it's positive. So that switch flipped. And that happened earlier in the year. So that switch flipped. That told us, hey, you should move some portion out of the stock markets. But how much? That's where we went to the strength signals. And believe it or not, the yield curve measure said it was flipped to no, that this isn't a strong signal. Now, several of you, especially if you watch any financial news, might have heard that we had an inverted yield curve. The yield curve they're looking at is comparing a 2-year Treasury bond to a 10-year. What's interesting about that is the research that really digs into this. That is not the two measures they use, and we use a different measure to look at, is the yield curve inverted, and that measure is still showing as a no. Then we went to the velocity measure, the other secondary strength signal, and it also was a no. It said, no, these are not the velocities that tend to show a really sustained market drop. So we did get a signal saying, hey, you should move something, but the two strength signals were kind of weak. So if the control panel looks like this, where did we go? Here's what we look like right now. In TAPA, it's about 68% growth and 32% defensive. We'll keep watching it, and if it changes need to be made, we'll do that. Now, so far, we've just been talking about the portfolio. So I want to remind you all, there's other things going on other than just what we're doing in the portfolio, especially if we've been doing financial planning for you, and if you're retired and we're doing cash flow management for you. I'm going to remind you that we have what we call the facets of Reliant harvesting. We have a harvesting strategy. These are processes above and beyond just buy A and sell B that really help us make sure that your money lasts your lifetime and that you can achieve your goals. The very first one I'll just remind you of just real quickly. Look, we've done analysis for you to decide what's your safe spending level. And when we figured that out, we did not assume everything was just going to keep going up and up and up. We do things called bad timing analysis, where we assume, hey, we are going to have bad markets in your lifetime. That's just a given. The U.S. goes into recession on average every 4.5 years. We know bad markets are coming. So we've already baked in assumptions of bad markets over certain kind of time frames in there. So when we tell you this is a safe spending rate, that already assumed bad markets occur. To remind you, we have liquidity reserves in the portfolios. A liquidity reserve is a bucket of money that's not overly sensitive during bad markets, that if we have to stop taking money out of either the core or TAPA, but you still need cash flow, we have a source to do that, where we can give TAPA and the core time to try to recover. So that's that. That's only 2 of the 6 facets of harvesting that we do here. And I just want to remind you of that, because actually once you start pulling money out of accounts, these processes become even more important than whether we bought A, sold B, or vice versa. So I hope you got something out of that. I hope it made you feel like, yes, we're being proactive and that you are well positioned to deal with what might come about. We welcome any questions. Feel free to reach out to any of our advisors here, which you can see here on the screen, or give us a call. We'd love to talk to you about whatever's on your mind. And in the meantime, I hope you have a great day.